Hey guys, and welcome to another week of managerial accounting. I want to apologize for getting this stuff up a couple days late, but nonetheless, you will have extra time to get it done. So all the assignments for this week will be due not on Monday, but the following Monday, which is April 8th, I believe. And that was that message kind of was spelled out in the agenda for the week. We are going to have exam 2, which covers chapters 8, 9, 10, 11, and 12. Now this week we're going to cover 2 chapters, 11 and 12. Chapter 11 talks about performance measurements in a decentralized organization. There's a lot of good stuff in this chapter, and please feel free to read this material on your own. But the only thing I'm really going to require, and it's going to be tested, is going to be return on investment, how to calculate return on investment, and what is ROI, what affects ROI. So that will be tested, and that's what we're going to cover here in this little lecture video. But like I said, the rest of the stuff, it's good stuff, but I think ROI will probably serve you guys a lot better in your future careers. Decentralization, looking at the different centers that are out there, the cost center, the profit center, the investment center. Yeah, that stuff's all important, but we're getting close to getting down to the wire, and I want to make sure you get all the really important stuff. Okay, so let's look at ROI. So after you complete this video, hopefully you should be able to compute the return on investment, which we call ROI, and you should be able to show how changes in sales, expenses, and assets have an impact on ROI. So before we start talking about what changes or what changes are going to impact the ROI, we need to talk about what is the ROI. Well, the equation on the screen pretty much defines what the return on investment is. We take our net operating income and we divide it by our average operating assets. Very simple to compute, but the information we get is really what's important, as well as how we manage our process, how we can impact that ROI. Okay, so as you can see, we start off with net operating income. So net operating income is used instead of plain old net income, right? So net operating income is the income before any interest and any taxes are deducted. If you've had any finance courses, or I'm sure you guys are all MBAs, or the majority of you guys are all MBAs and whatnot, or have some business aspect going towards your career, you might have seen EBIT, earnings before interest and taxes. So that's what we're going to use as our numerator. And then the denominator is the average operating assets. Okay, how do you calculate the average operating assets? It's very simple. You take the amount of assets, operating assets, that we have at the beginning of the period, plus the operating assets that we have at the end of the period. You add those two up, divide by 2. That's your average operating asset. What's more important is looking at what makes up operating assets. Well, everything that we need in order to operate, right? We need cash to operate. Accounts receivable, those come from operations, right? We sell something, somebody says, hey, can't pay you now, pay you in 30 days. We offer credit. When somebody owes us money, that turns into a receivable. Inventory, PP&E, property, plant, and equipment. That's also considered an operating asset, as well as productive assets, right? Any asset that we have that we use in our in our core business that helps us generate revenue. That's what productive asset is. Okay, so let's kind of dig into ROI, and there's actually another way that we can look at ROI. Okay, we can look at return on investments, or we're looking at return on investments, excuse me. We can break this down into two parts, and this is what's known as the DuPont method. Okay, very simple. Basically, what this DuPont method does is it takes the return on investments and it breaks it apart into two separate pieces. One piece being the margin, the other piece being the turnover. Okay, so when we're looking at the margin, notice what we're calculating here. We're taking our net operating income, which is our EBIT, and we're dividing it by our sales. Okay, that gives us, that's one way that we can calculate our margin. The second piece of the ROI is the turnover. How often are we turning over our assets to sales, or what's the ratio rather to average operating assets and sales? So in order to figure out our turnover, we take our sales and we divide it by our average operating assets. Okay, we take those two pieces, the margin and the turnover, we multiply them, and that also gives us the return on investments. Okay, now why would you want to look at ROI from the DuPont method as opposed to just looking at the straight ROI calculation, meaning we take EBIT or net operating income and divide by the average operating assets? Well, because when we break it down into our two parts, we can see how us as managers can impact the return on investment. We either increase our margin or we increase our turnover. Okay, before we jump into an example, I just want to kind of mention one thing about net book value versus gross cost. Okay, gross cost says, here's how much I paid for the asset. I paid $1 million for a piece of machinery. Okay, the book value, or the net book value, takes our acquisition cost, which would be that $1 million, and it subtracts, or we subtract out, any accumulated depreciation. Okay, now I'm assuming that we had that intro to principles of finance, and remember that depreciation is that non-cash expense, and we use it because of the matching principle, right? We have to match up the cost with the revenue that we generate, and basically that's what this depreciation does. It helps us match up the cost of the asset with the revenue that was generated for each period. Okay, so we use the net book value to figure out what our net operating assets are, meaning we don't use the gross cost. We use the beginning net book value, the ending net book value, add those up, divide by 2. That gives us our average. Okay, so let's look at a quick example here. Okay, so what do we have? Well, we have the Regal Company. They have net operating income of 30 grand. They have average operating assets at 200,000. They give us our sales, which is 500,000, and they give us our operating expenses of $470,000. So from here, we can figure out what the ROI is, right? We could do it one of two ways. We could take, well, no, we can't, because we don't know, or yeah, we do. I'm sorry, I apologize. We have our net operating income, and we could divide that by our average operating assets. But we're going to use the DuPont method, and we're going to say, okay, first I'm going to calculate my margin, then I'm going to calculate my turnover. Excuse me, sorry about that. And then I'm going to multiply my margin and my turnover together to figure out what my ROI is. So let's walk through the example. So the first thing we do is we look at our margin, right? We know our margin calculation is net operating income divided by sales. we get 6%, okay? Then we calculate our turnover, right? How many times do our assets turn over relative to sales, or what's that ratio, right? Here we have 2.5 because we took the sales of 500,000 and we divided it by the average operating assets of 200,000. So our ROI then is 15%. Our return on our investment, we get 15%. Now, why is that important? Let's take it a step further. Let's look at some financial aspects of this, right? We're in a company, and actually we're going to see in chapter 12 differential analysis and how do we make decisions, right? Well, the ROI may serve as may help us determine, should we accept the project, should we not accept the project, right? And when you get into finance, you're going to get into net present value and all that other good stuff. But right now we're just concerned with calculating the ROI. As long as we know how to calculate that, we're good. How do we use this to make decisions? Well, let's assume that we have an opportunity to invest in one of two projects, okay? And how do we know which one to invest in? Well, the first thing we're going to do is we're going to calculate the return on investment of each of these potential projects, right? Based on projections, how much sales we think we're going to have, the operating expenses to generate those sales. Again, it's all a guesstimate, right? And we put the numbers together and we say, we have one investment that does, or one project that promises, or I don't want to say promise, that's not a good word. One project that shows a return on investment of 15%. Project 2, based on the sales that we anticipate, the assets that we have, the sales we hope to generate, the expenses we think we're going to incur. Project 2 gives us a return on investment of 6%. Well, based on that, you're going to pick the project that is going to give you the highest return on your investment. So you'd pick project 1, which is 15%. Okay. So let's look at what we do here. Okay. Meaning, when we make a decision, there's always going to be some moving parts, so to speak, right? Meaning, we're going to see this in chapter 12. Do we sell a sell a product as is, or do we go further and process it and sell it down the road, right? Or somebody comes to us with a special order, right? Hey, you make bracelets or watches, whatever, it doesn't matter. Hey, I want you to make me 20 or 30 special watches that are going to have something special to them, right? Maybe they have an emerald or a diamond, I don't know, something in the face. The point is, it's different, right? Well, in order to do that, we have to buy maybe a special piece of equipment, whatnot, right? We'll see in chapter 12 about differential analysis. But the takeaway here is recognizing that we may have to invest in operating assets to increase sales. That is a possibility. Well, that's going to have an impact on our ROI. And before we even look at this, I just want to kind of give you a quick overview. Which one? Right here. Okay. So think about it this way. Okay. Average operating assets, right there in our turnover, it is in the denominator. Okay. So if we increase our average assets for turnover, that's actually going to decrease our turnover. Okay. However, if we look at our margin, right? If in margin, the calculation is net operating income over sales. In this case, our net operating income is in the numerator, right? It's the top number. So if we decrease our numerator, our ROI decreases. If we increase our average operating assets, our ROI actually increases. Okay, so we have to figure out, is it beneficial for us to increase our assets to hopefully get more sales, and then that's going to obviously have an impact on our ROI. Okay, so let's assume that Regal's manager invests in a $30,000 piece of equipment that's going to increase sales by $35,000. Okay, but it's also going to increase our operating expenses as well by $15,000. So we have new numbers, right? Our net operating income is now $50,000. It was originally 30, but it went up to 50,000. Okay, average operating assets went up to 230,000, and the sales went up by 35,000, so they're 535,000, and our operating expenses went up by 485,000. So the takeaway here is recognizing, okay, what's going to change, right? Well, the net operating income, they tell us, is going to go, well, they don't tell us, we have to figure that out, is going to go up by 20 grand, okay? The average operating assets obviously are going to go up by 30,000 because that's the 30,000 piece of equipment that we had to purchase. They tell us that, hey, total sales are going to increase by 35,000. So our sales go up by 35,000. Our operating expenses go up by the 15,000. Okay, so we can calculate what our net operating income is here. It's 50,000, they give it to us, but where did that 50,000 come from? Well, it came from sales minus operating expenses. So we calculated the increase in the sales, the increase in the net operating income by increasing sales by 35,000 and increasing our operating expenses by 15,000. We ended up increasing our net operating income by 20,000, which we got to 50. Okay, I hope that makes sense. As I was explaining it definitely made sense in my head, but if not, please reach out to me. I have no problem working with you guys. All right, so let's look and see what happens once we crunch the numbers, right? Our margin went up significantly, right? Our new margin is 50,000 net operating income divided by sales, which is 535,000, gives us a margin of 9.35%. Okay, it was 6. Now it's 9.35. So it went up a lot, right? However, our turnover actually went down slightly. Okay? 535,000 divided by 230,000 gives us a turnover of 2.33. So that means that our return on investment is 21.8%. So by buying $30,000 of equipment, it's going to increase the sales, it's going to increase the expenses, but that increase in sales it offsets the increase in expenses, so our ROI goes up. Okay. Some criticisms of ROI. This is one of your questions in your study guide. Okay, so we didn't get into the balanced scorecard really. Basically, the balanced scorecard helps us to track our business, not just in financial measures, but also with other measures, right? Things like performance measures, customer service. We're going to look at our internal business perspectives, right? Or we're going to look at our business from an internal processing perspective. Are we coming out with new products, right? How long does it take us to introduce new products or bring new products to market? Okay. What about our delivery cycle, all our manufacturing cycles, right? Are we efficient? And then another aspect of the balanced scorecard is the learning and growth perspective. Okay. So basically, we take our business and we say, you know what, um, we want to see how well we're doing, right? So how are we going to measure our performance? Well, up to this point, it was all finance, right? How have we improved financially? Have we increased our sales? Have we managed our costs, right? Now we're saying with this balanced scorecard, we're also going to look at other aspects as well. Things like customer satisfaction, right? Are we giving good customer service, right? Our internal business process. Are we managing our business process efficiently and effectively? And then finally, are we learning and growing? Are our employees, are our managers, are they learning to do new things? Are they increasing their abilities? Um, are they improving? Are they changing? So that's one criticism about the ROI says, you know what? Yeah, it's great, but if we don't have the balanced scorecard, maybe we're not exactly sure how to increase that return on investment. Okay. Another criticism of ROI says that as managers or as new managers, right, coming in, we're going to inherit some committed costs, right, that we have no control over. My predecessor bought a $50 million machine, right? Well, that's a committed fixed cost. The money's already committed, they already bought it. Um, so it's difficult to get out of those committed fixed costs. And I remember we talked about those, I believe, I want to say chapter 1, I think. Okay. So that's the second criticism. Third criticism deals with um, management and how do we make sure that they're making the best decision. Okay. What do you mean by that? Well, let's say that we make the ROI, let's say ROI is king in our company, right? We evaluate all managers on return on investment. Okay. And let's say that our incentive program is tied to the return on investment. Okay. And let's say that a manager is close to um, close to his budget, right? And let's say the budget, or I'm sorry, not the budget, his goal. And let's say that we pay a bonus. This manager will receive a bonus if he constantly has an average ROI for the year of 10%. Okay, 10%. Let's say it's getting close to the end of the year, and the manager is presented with two options, right? Project 1, Project 2. Project 1 has ROI of 5%. Project B has a return on investment of 4%. Okay, so right off the bat, we say, hey, we're going to take the 5% because that gives us the higher return on investment. But the manager knows if he accepts either one of those projects, his total average ROI that we're keeping track of for him, that we're um, evaluating him on, it'll drop to maybe 9.5%. Okay. Total ROI drops based on him accepting these new projects. Well, or she, sorry. Well, this manager says, you know what? If I accept one of these projects, I'm not getting my bonus. Yeah, it might benefit the company by picking this or undergoing this project 1, which gives me 5%, but that's going to hurt me personally, so I'm not going to invest in anything. Okay, so that's what they mean when they say that managers are going to reject a certain ROI because they're not acting in their fiduciary responsibility to the company, and they're saying, hey, you know what, I got kids to feed, the kids want a pool, my spouse wants whatever, a new car. I need this bonus, so I'm not going to do what's right for the company by investing in either one of these projects because that's going to hurt me personally, right? So that's what they're talking about. All right, so that's the gist of ROI. In your study guide, you have exercise 11-1, which I forget what page it's on. Let me turn to that real quick. It is on page 527. So we're going to do that here, okay? So we have, bear with me here. That's not what I want. You know what, we'll just do it this way. So you have a three chart, or I'm sorry, a table, I believe with two or three, a table with 2 or 3 columns in it. Doesn't matter how you set it up. We're going to go through the exercise 1 now. Okay, so we have this company. It's a division of a major oil company. They provided various services to operators of the North Slope oil field in Alaska. They give us data concerning the most recent year. Sales is 7.5 million. Net operating income is 600,000, and the average operating assets are $5 million. So the first thing that we want to do is we want to compute their margin. So in order for me to calculate margin, all I need to do is take my net operating income, I'm going to abbreviate that as NOI, okay, divided by the sales. Well, that's like easy peasy, right? I can do that, no problem. I know my net operating income is 600,000, and I'm going to divide that by, my net operating income is 600,000. I'm going to divide that by my sales. My sales are 7,500,000. That gives me a margin of 8%. Okay. Number 2 wants me to compute the turnover. Well, we can do that very, very easily because we know the turnover is sales divided by average operating assets. So if I take my sales of 7,500,000 and I divide that by my average operating assets of 5 million, I can then determine what my turnover is, which is 1.5. Okay? So the third thing, or the third part of the problem says, hey, what's the ROI? Well, that's easy, right? I already got my 2 pieces. I already have my margin, and I know I need to multiply that. Oh, usually helps if you could spell. I take my margin and I multiply it by my turnover. So I'm going to take my 8% and I'm going to multiply it by my 1.5. I end up with an ROI of 12%. Okay, so not too bad. And again, only the stuff concerning ROI is what you would possibly see on the test. When we come back in our next video, we're going to jump into chapter 12. Okay, we will cover all of chapter 12, not the appendixes, just the just the main part of the chapter, the important, the bulk of the important stuff. So we'll see how to make a decision. So when we come back, we'll discuss chapter 12 and go from there. So thanks for tuning in, and we'll see you in our next video.